Do the obsessions of stock market investors make sense in what is now the 8th summer of a long rally for the S&P 500? Consider Salesforce, a company which has always been expensive thanks to excitement about the potential for its business. Software sold as a subscription service rather than a simple product which is licensed. Sales have quadrupled in 5 years, helped by a few acquisitions, so the company is valued at a cool $53 billion, 8 times the revenue it reported last year. Then there is Expedia, a travel agent. It too offers a fast-growing online service. It's doubled sales in the last 5 years, also helped by acquisitions, yet the perception is vicious competition for hotel bookings and car hire. It makes the business harder to expand, perhaps less valuable than software. In the considered judgment of the market, Expedia is worth $19 billion, around 3 times sales. It doesn't help Expedia's case to actually make some profits, $765 million last year. Salesforce, by comparison, has lost money in each of the last 5 years, an accumulated deficit of more than $800 million. Shareholders, though, are free to imagine what might one day come, untroubled by the reality of profit margins. Expedia has also repurchased shares over the same period, a sign perhaps of diligent maturity. Salesforce, well, it's given away 1/5 of the company, largely to its staff as a form of pay, a practice which seems to be treated as signal of its great future. Yet there is one way in which the companies are identical. Both reported sales of $6.7 billion last year and spent half that amount on sales and marketing just to persuade customers to show up, a greater proportion than any other member of the S&P 500. Indeed, 5 years ago, Salesforce was also spending $1 on marketing for every 2 it made in sales, when it was 1/4 of the size. For a company with a great future, it appears to work very hard to find and retain customers. As Expedia fights Priceline and TripAdvisor, so must Salesforce surely battle larger rivals Oracle and Microsoft. As for the valuation disparity, perhaps it reflects a more general lack of fast-growing companies to buy, or a sort of investment muscle memory about the type of business which is supposed to excite.